Well, hello and welcome to Finding Alpha. I'm Nigel Dsouza from the Mumbai News Center. Well, what are the top sectors, stocks to watch in 2026? We have with us Nikhil Khandelwal, Managing Director at Systematix Group, who joins us on the show to share the big bets across PSU Banks, SFBs, the recycling theme, as well as pharma. We'll get the clear rationale behind each stock that Nikhil wants to talk about. Well, Nikhil, thanks a lot for coming down to our studio. And we're interested to know about the top themes that we're going to be talking about. But before we talk about that, I just want your sense, in terms of the market mode. 2025 was definitely a difficult year. But 2026, what a rocky start to the year. What is the feedback that you're getting on ground?
Right. No, thank you for having me on the show. 2026 was anticipated to be a rocky year, given what all has been happening towards the fag end of the last calendar year, and also what all happened through the entire 2025. I think we all are driven by data, and from our perspective, when we look at what's happening as far as numbers are concerned, within the entire Nifty 50 basket, when we look at about last 10 quarters of on sales growth for companies in the Nifty 50, the number is close to about 6%.
Okay.
Right. This is while accounting for all the benefits which has come in from the government as far as Indian economy is concerned, whether the GST rationalization, the income tax rationalization, etc. And on ground as well, when we talk about the consumption as a space, within the consumer theme itself, when we look at the volume demand across the larger consumption bucket, our data is pointing to a number around 3 to 4% growth. So, this data about the overall sales growth among the larger companies, and especially in the consumption basket in India, is something which has been top of our mind, and which is top of the mind of the government as well, as far as their action on ground is concerned, which they were trying to correct. But whether it is having the larger effect, I think it is taking much longer, and it will be a much harder ride. I think that is what is, one of the big factors playing into as we enter 2026. Second is our GDP data. I think the tax collection, the tax collection data, I think we are a gross tax collection over this year is about 3% or so in the first half. So to make up for the government target of about 10 to 11% in the second half, we have to have a tax collection upwards of 20%. So it's a number which is, we all know, is difficult to come by. So the data show that we are going to have a hard run as we enter into 2026 and we develop into this year.
Okay.
And on top of that, the export businesses are all, kind of suffering from what's happening on the tariff front. So a combination of these factors, we believe that 2026 will be a hard-fought year as far as equities is concerned.
Okay, all right. You're highlighting a couple of soft points out there with regard to the top-line growth as well as the tax collection. That's why we have you, Nikhil, on the show, and we want to understand some themes. The theme that you're focused on first up is on banks, and the system-wide loan growth, that's expected, I think, to be early to mid-teen in the coming year. That's going to be driven primarily by retail as well as MSME leading. But now there's hope that even the corporate books gradually starts to see some book. In this sort of a backdrop, I think you prefer the PSUs. Give us the rationale out there, because some of these big names, in comparison to their historical averages as well, are doing pretty okay. But you prefer PSUs. Why?
No, I think we are looking at businesses which are balancing growth and have sufficient room for valuation. I think, as I said, as I started, the markets are such, and you need to have a right balance of growth and valuation on your side. And as far as growth is concerned, PSUs over the last 18 months have been on top of their execution. If you look at the overall system-wide advances growth, the PSUs have surpassed their own history as far as the market growth by growing at close to about 13% in FY25 on advances. The PSUs, in terms of their credit quality as well, have improved significantly. Now the credit quality of most of the large PSUs is on neck to neck with the large private sector banks. On top of that, PSUs in the market where the rates cycle is on a downtrend, and the NIMs of the banking sector are generally under pressure.
Yeah.
The PSUs are actually stepping up on their other other income growth, driven by distribution income, driven by credit card growth, etc. They are stepping up. A lot of that data is something which we are seeing live on ground over the last 6, 12, 18 months perspective. And we believe that the PSU pack, driven by the top 3, 4 companies, will drive 13 to 14% advances growth, will provide very strong protection on margins, maybe even improvement on margins in certain packs, have very strong balance sheet, and are available at price to book from as the highest, probably the highest quality bank is available at one-time price to book. Right. For a period where their ROAs, return on assets, is likely to be between 1.1 to 1.5%. So a combination of these factors, PSU has been our top pick as far as markets and in general in financials for the last 6 months, and we continue to remain.
All right. So you like these PSU banks. You believe they've upped their game. They're eating to market share, and their books as well are in far better shape. We got that. The 2 stocks, I believe, from the PSU basket that you like are Bank of Baroda as well as Union Bank of India. And both of them, one of the points are, both of them have that valuation discount. But that's been the trend, right? They trade at less than 1 times. And as you mentioned, the return ratios are improving. Right. So then it should deserve a better multiple. Right. Give us a little bit more color on particularly these 2 names that you like.
No, I think Bank of Baroda in particular is showing probably amongst the entire PSU pack the fastest credit growth, so advances growth. So advances growth in this bank, we are expecting that this year will be upwards of, and for the next couple of years will be upwards of 14.5%, 15%. The bank, according to us, besides SBI, among the larger banks, has been the most diversified in terms of its book, whether it's presence in India, its ability to provide loans to companies for their overseas investments, acquisitions. So when we talk about the overall banking space, and you touched the point about the corporate loan book as well, and we are seeing that while the retail and MSME is one category which is growing at about 9 to 10%, the corporate loan book for most of the banks and the entire sector has been a laggard. Yeah. It has been growing at 1-2%. We believe it is trending in the range of now 4 to 5% as we end this year. And one of the banks which we believe will benefit the most out of this piece of growth is going to be Bank of Baroda.
All right. Bank of Baroda, and the other pick I think you have is Union Bank of India. So got that. I think we should just pull up a query because we have a query that's coming in from Shashank Taneja, who writes to us from Noida. And the query that he's giving us is basically he holds close to around 20 shares of SBI at around 393 rupees since 2021. He wants to know what is the long-term outlook on the stock. On SBI, what's the view? I mean, the gentleman from Noida is dancing his way to the bank. What would your advice be? Better times ahead, given that you're positive on the entire PSU pack?
Yeah, no, definitely SBI, even at these prices, definitely is a big positive. SBI amongst the PSUs is probably has the best mix of the levers to drive margins up. Their credit card business, while it is housed under a different subsidiary, their subsidiaries run one of the largest life insurers and mutual funds. So the bancassurance and the distribution business income, all that is continuing to kick in, and they are going to be one of the strong wealth creators in our view, even in difficult markets. So stay put with that.
All right, stay put. That would be the advice. Shashank, I hope that's helpful. But let's stick to this financial and banks theme as well. You're bullish, Nikhil, on some small finance banks. They constitute a very small proportion of the lending system. But you believe they're placed to give good returns in the next few years? Tell us the top 3-5 reasons that you believe that these small finance banks that obviously have various regulations on their lending as well as on their borrowing mix. But give us the rationale first in terms of this theme. How has it evolved?
Right. No, SFBs, as you rightly said, constitute a very small percentage of the overall banking sector. If you look at the entire credit book in the Indian market, SFBs are just about 1.5%.
Okay.
Having said that, in the last 7 years, they have grown from 0.5% to 1.5%. So they have actually taken a significant share, although with a small base. The data also is quite interesting as far as credit growth advances growth is concerned. SFBs have grown at about 35% CAGR over the last 5 years, compared to private sector banks, which have grown at about 16-17%, PSUs at about 9-10%, and the overall sector growing at 12%. the entire SFBs as a pack were also, were actually created with the concept of, banks which were making a significant investment in microfinance or were very strong regional leaders. So they had a significant overhang of having their book being significantly microfinance heavy, which is unsecured loans.
Correct. What have they done about that, if you have a number?
So just to give you in terms of numbers, in 2018-19, across the top 5-6 SFBs, the microfinance book constituted between 80 to 90%, except for AU and Capital SFB, who didn't come from the microfinance background. The rest of the people, at 80 to 90% of their book was microfinance, which today is below 20%. Okay. So unsecured book has gone down from 80 to 90% to about 20%.
Got that.
Secondly, in terms of geographic presence, most of these were centered around a certain geography. AU around Rajasthan, Capital SFB around Punjab, Equitas around, in the southern market. So they have all diversified their geographic presence also. And as a result of that, now incremental, if you see the last 3 years of data, the incremental 70 to 90% of the bank branch expansions for these banks is happening outside of their core market. So they are diversifying across geography, making more secured lending book. And thirdly, in terms of the ability to sell new products, they have gone into high yield products like home loans, gold loans, etc. That piece of the book is also beginning to become more material. So combination of these factors, growth, the secured book driven lending, I think the whole pack is due for re-rating. They will be the strongest growing pack in the entire banking space. They are getting universal banking licenses. AU has already received. Ujjivan is next in line, where they have applied in Feb. And they are due to, hopefully will receive in due time. And next year, possibly Equitas will also file for the universal bank. So these banks are graduating into universal banks, which has huge trigger effects on their overall ability to grow faster. Combination of these reasons, SFB is one very interesting pack.
Well explained. We take that on board then, Nikhil. And AU Small Finance Bank and Equitas, those are a couple of names that you mentioned, but we've got a query on Ujjivan as well, which we'll address in just a bit. But on both these two stocks, AU Small Finance Bank has been quite strong, actually. And I think, you all were bullish for some time. It's closer to your target price or around those levels. You still believe the bank is well placed from here? And also the other one that you were talking about, Equitas. What kind of returns do you think these stocks can give from here, say in a couple of years from here on?
So I think AU is a small finance bank due to become a universal bank, but is run like a universal bank all through. The key thing which AU differentiate itself is almost close to about 90% secured book and a growth which is unprecedented in the industry at upwards of 30% over the last 5-7 years. We believe that even at this high base, AU with its strategy plan, which they have shared with the market in general, we believe that they will still grow at upwards of 20%. And with the book quality amongst the best in the entire banking space. So as a result of that, we believe that the bank will continue to get valued at somewhere between 3 to 4 times a book on a 1-year forward basis, and hence we continue to remain quite positive on AU in general. This bank will get compared with the top of the line players in the private sector, and that's how this bank will get valued.
And the other one, Equitas?
And Equitas, on the other hand, has actually runs other than AU. I think this is the second largest SFB by loan book size. And 90% of their book also, about 85% of their loan book also is secured. But they had significant provisions over the last 12 months or so, which has all started to come off. And but the market is yet to see the benefit of low provisioning and the growth built within the entire book of Equitas. And as a result of that, the stock is trading at close to about 0.9 times book. for a bank which will probably grow, in our view, at close to about 40-45% CAGR over the next couple of years. So it is basically the end of the painful period as far as provisioning is concerned, and significant growth and deep value.
Got it.
Hence Equitas.
Take that on board. Let's talk about some of those fancied sectors. Metals, they continue to twinkle. You have that melt up that's taking place. But now you believe there's another way of playing it. You're seeing a good opportunity in the recycling theme. Explain this to us.
No, so recycling as a space is something which has been catching investors' attention. There are not many listed companies. There are only about 3 or 4 large listed companies. While we look at the recycling space, we like the non-ferrous metal recycling space. And we believe that this is probably the most organized and the large-scale opportunity as far as India is concerned. And within that pack, I mean, this space, if you talk about, it's about a $30 billion industry today, growing at about 8 to 9%. But what's happening is that while we look at companies in this space as recyclers, they are becoming, they are changing their tack from being recyclers to actually recycled metal producers.
Okay.
So if you see the overall non-ferrous metal space, we have been seeing the prices of copper, aluminum, lead. They've been extremely volatile, right? And what this volatility of this non-ferrous metals has led is created a significant problem for the end user industries in terms of their procurement prices, their overall, the processing cost. Also, the energy consumption when you use the primary metal to produce the final products is extremely high.
So this is ESG compliant?
So this brings to the topic of recycled metals, and the government realized this as a very important aspect of the entire manufacturing ecosystem. So they have actually created significant mandates as far as using recycled metal for producing, for user industries like electronics, automotives, to produce their final products. They have also provided significant import benefits for importing scraps, of importing used batteries. And on top of that, there is ESG mandate, because for corporates, they need to use as much as recycled product, which leads to lesser use of energy, and provides similar to better yields. Hence, recycling as a space has been, and the demand for recycled products has been on a tear. Companies are, the leading players are growing anywhere from 20% to 30-35%.
Right.
And hence, this is an area which we like a lot. We believe this is a extremely efficient way to play the entire non-ferrous metal space, and as well as the entire ESG compliance theme within the manufacturing ecosystem.
Got it. But the poster boy has been Gravita. But I see that on your radar, you have Jain Resources as well as Pondy Oxides. I think you like both those two. So tell us why.
No, so from our perspective, we have been looking at this industry from which are the companies which are investing in creating a global supply chain.
Okay.
Global supply chain in this industry means strong procurement globally, strong ability to sell globally. So both Jain Resource Recycling and Pondy sell about 60 to 65% of their sales is to global markets, is exports. Right. They are both LME registered sellers, resellers, and that provides them a significant premium as far as selling any recycled products is concerned.
Okay.
Thirdly, in terms of the value-added products across the copper value chain, across the tin value chain, across even the lead value chain, aluminum value chain, these two companies are ramping up capacities at the fastest pace.
Okay.
So a combination of these few factors, we believe that these two companies will provide the strongest earnings growth over the next 3 to 4 years. The one very macro picture within this recycle space is about the use of technology.
Right.
And these companies have also been have at least been talking about and exhibiting in their data as well about very strong yields as far as their recycling processes are concerned. So I think these companies are well placed, will provide significant earnings momentum over the next 3 to 4 years.
Got it, Nikhil. So we have PSU Banks, small finance banks, and some of these recyclers that you're quite bullish on. I'll tell you what, we want to hear about your take on pharma. And we've got a few queries that have come in as well. For the time being, we take a short break, come back. We'll continue the discussion. We'll also answer some of the queries that are coming. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha, and we have with us Nikhil Khandelwal, Managing Director at Systematix Group. Nikhil, we've gone through a few sectors, but another interesting one is pharma. And our next query actually is coming in from this sector, so I'd like to know what you like from this pack. Venkatesh Iyer, he writes to us from Andhra Pradesh. He holds around 60 shares of Sun Pharma at around 926 rupees since 2015. He wants to know the future prospects of the stock. What's your view? Pharma is an interesting space because there is still some pricing pressure in the United States, but some of them on the domestic front are doing pretty okay. So what would your advice be with regard to Sun Pharma, and what do you like from this pack?
No, I think in general, the entire pharma pack has been significantly derated. It is probably at the, from a price to earnings perspective and PEG perspective, price to earnings driven by the growth perspective, they are at one of their lowest phase. Having said that, in the entire pharma pack, I think Sun Pharma stands out as not just the largest pharma company in India, but also the fastest growing pharma company. And they continue to deliver, in our view, 10% growth on their domestic business, while having the least percentage exposure to US generics, which is actually the most riskiest piece of the portfolio of any pharma company. So within that, while they have 30% of the business from US, 10% is only exposure is to the generics part.
So larger part is to
the specialty. So as a combination of that, we believe that Sun Pharma will it should be a must-have in your portfolio. And if somebody owns it, I think they should continue to own it going further. Also, Sun Pharma has probably the largest percentage of cash in their books as a percentage of their market cap. So almost 10% of their market cap sits as cash. So their ability to buy growth in a market which is globally so volatile, I think it is going to be a very important piece which people are missing, and that is actually going to create a lot of positive triggers as far as Sun Pharma.
But what if they are too adventurous and that cash in their books, they go to buy it very big, or they go to take a very heavy dose of the medicine? Because there are those rumors, they have denied it, but will that be viewed negatively, or do you think it will fit well into the scheme of things?
No, see, all of these pharma companies are big buyers and big contenders of acquisition globally. And Sun Pharma, what we understand is they are looking for more specialty product businesses, and that is a way to go. Time will tell what they finalize on, but definitely having the ability to acquire without leveraging your balance sheet is something which Sun Pharma has. They have the ability to scale businesses. So combination of these two factors, I won't be too worried at this point of time.
Okay, all right. So positive on Sun Pharma, but you have to throw in another pharma stock as well. I believe Cipla, you believe prospects are good from there. If you could quickly run us through the rationale.
Now, Cipla also from, I think, just those two factors about very strong domestic market growth and having the right levers to grow globally. Their Indian business, we believe their business ex-US will, in our view, will grow about 9 to 10%. And their exposure to the US market is also close to about 30%. But they have a huge right to win in the inhaler, the entire category. And they have been ramping up their product basket across that value chain. And we believe that from an ROE, from a PEG ratio perspective, Cipla will give us between 15 to 20% earnings growth. So hence, it's available at quite an attractive value and should be in the portfolio.
All right, Nikhil, it's been a pleasure having you on the show. Thanks a lot for joining in on Finding Alpha, giving us those themes with the stocks backed by rationale. It's been good having you. Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching.